In this video, I'm about to show you how San Francisco's $1.56 billion hotel empire collapsed faster than anyone predicted, not through one dramatic implosion with shattered glass and sirens, but through the kind of financial unraveling that starts with weak bookings, spreads into valuation panic, and ends with some of the biggest hotels in the city going from trophy assets to public warnings almost in real time, starting with the moment everybody realized these were no longer just struggling hotels. They were symbols of a citywide hospitality breakdown. That is one of the nastiest parts of this story. Most people imagine hotel disasters as physical events: a flood, a structural defect, a tower that never opens, something cinematic, something you can point at. San Francisco's hotel empire collapse was uglier in a quieter way. It looked like underperformance. It looked like empty rooms in a city that used to print business travel. It looked like convention weakness. It looked like executives deciding that the math no longer worked. And eventually, it looked like Park Hotels and Resorts, one of the biggest lodging REITs in the country, deciding to stop making payments on a massive $725 million loan tied to Hilton, San Francisco, Union Square, and Park 55. That is not ordinary bad news. That is the corporate version of putting a suitcase on the bed, taking one last look at the room, and walking out without pretending you are coming back. Because these were not minor properties. Together, Hilton Union Square and Park 55 formed a huge chunk of downtown San Francisco's hotel identity. Big room count, convention-oriented, city-shaping hotels. The kind of assets that help define a market's confidence. If those assets start buckling, it tells you the problem is not confined to one weird block or one badly managed building. It tells you something deeper is off. To understand why this story hit so hard, you have to remember what these hotels represented in the better years. San Francisco was supposed to be one of those urban hotel markets that serious investors could trust. Global city, giant convention business, expensive room rates, corporate travel, international visitors. Tech money, a downtown core dense with reasons to stay overnight. In that environment, a pair of giant Hilton-branded hotels near Union Square and the convention ecosystem did not look reckless. They looked logical. That is how you get to the 2016 valuation number that now sounds almost haunted, about $1.56 billion for the complex of the two properties. At the time, that kind of value told a very specific story. It said San Francisco was still San Francisco in the strongest possible hotel investor sense. Premium market, durable demand. Difficult to replicate. Politically messy maybe, expensive definitely, but still the kind of place where large hospitality assets would keep attracting cash because the city's economic engine felt too powerful to fail for long. That was the promise. 2 giant hotels, thousands of rooms, heavy convention traffic, reliable business travelers, constant urban demand. A machine, not a gamble, and that is what makes the collapse so vicious. Machines are not supposed to beg for mercy this quickly. And when fortress assets start behaving like liabilities, the collapse stops being a finance story and becomes a civic one. Everybody notices. Tourists notice, lenders notice, and City Hall notices. Most of all, rival hotel markets notice and start smiling a little. This is where the story gets important. If one hotel underperforms, maybe it is management, maybe it is dated rooms, maybe the brand drifted, maybe the competition got better. But when 2 of the city's biggest hotels start getting crushed at the same time, the diagnosis changes. Now, you are not looking at a property problem. You are looking at a market problem. Downtown San Francisco took multiple hits that stacked on top of each other in a way hotel owners hate. First, pandemic shock destroyed normal urban travel patterns. Then business travel recovered slowly. Then convention demand stayed weaker than the old model needed. Then office occupancy stayed depressed, which hollowed out the surrounding district. Then the city's image problems, crime headlines, street disorder, retail closures, office vacancies. Civic pessimism kept feeding the broader narrative that downtown San Francisco was no longer functioning like the premium urban machine investors had paid for. And hotels are brutally exposed to narrative. A hotel does not just need a building. It needs a reason for strangers to come sleep near that building. If the surrounding district feels weaker, emptier, less convenient, less prestigious, or less essential than it used to, that damage flows straight into hotel performance. That is what started happening here. These properties were built for a version of San Francisco that was constantly generating reasons to stay downtown at scale. Once the city stopped producing those reasons with the same force, the whole valuation story started to rot. The real shock point came in 2023, when Park Hotels and Resorts announced it would stop making payments on the loans secured by Hilton, Union Square, and Park 55. That mattered because public surrender by a sophisticated hotel owner changes the whole tone. This was not a mom-and-pop operator saying times were tough. This was a major public lodging company effectively saying, "We have looked at the city, looked at the performance, looked at the debt, looked at the outlook, and this no longer deserves more of our money." That is a brutal sentence, even when it is not said out loud. And the company more or less said the quiet part anyway by describing San Francisco as facing major challenges and deciding the best move was to hand the problem toward the lender side rather than keep feeding it. That is when the story stopped being "downtown is soft right now" and became one of the largest owners in the sector just wrote off a huge San Francisco bet. When big money quits publicly, everyone else starts recalculating in public too. This is the number that makes the headline work. The two hotels had been valued at about $1.56 billion in 2016. By 2024, reports indicated the valuation had fallen to roughly $553.8 million. That is more than $1 billion in value wiped away. Read that again? More than $1 billion of value gone. Not from some experimental crypto resort in the desert. Not from a bizarre vanity tower that never made sense. From two giant, recognizable San Francisco hotels that once sat right in the middle of the city's supposed hospitality durability, that kind of drop does not just hurt the owner. It humiliates the narrative. Because valuations are stories with spreadsheets attached. A $1.56 billion valuation says one thing about a city. A roughly $553.8 million valuation says something very different. Of quote. It says the market no longer believes the old assumptions. It says recovery is not just delayed. It says the old pricing world may have been erased. And once that happens, everything downstream gets uglier. Lenders get nervous. Bond ratings get downgraded. Distress becomes visible. Potential buyers circle like vultures, not admirers. And everybody who once said, "These are irreplaceable assets," suddenly has to explain why irreplaceable assets are being repriced like damaged inventory. Calling this a hotel empire is not even that dramatic. These were not tiny boutique properties. Hilton Union Square alone is one of the largest hotels on the West Coast. Add Park 55 and you are talking about a huge room count concentrated in the same downtown ecosystem. Together, they represented a kind of scale that only works when the city around them is still feeding demand into the machine. That is why the collapse became so symbolic. When little hotels suffer, analysts call it selective distress. When giant convention-oriented core assets start unraveling, people start wondering whether the city's whole hotel model is being reset. These two properties effectively became a public chart of downtown San Francisco's hospitality pain. And because they were so large, their distress seemed to confirm every negative story the market was already telling about San Francisco. That is what made the fall feel faster than expected. Once the narrative broke, the empire stopped looking solid and started looking overexposed. One thing people miss in hotel collapse stories is that distress does not stay on the balance sheet. It leaks into operations, labor, and city economics. Big urban hotels are employment engines. Housekeeping, front desk, engineering, food service, security, banquets, events, maintenance, sales, management, laundry, valet. And because these properties are convention-oriented, they also support a wider ring of city activity restaurants, cabs, vendors, nearby retail, event production, entertainment, and all the other invisible jobs that depend on thousands of travelers showing up with expense accounts and rolling luggage. So when a pair of mega hotels starts failing, the damage is not just investor pain, it is ecosystem pain. The city loses confidence, workers lose stability, nearby businesses lose traffic, convention planners get one more reason to hesitate. And every hesitation hurts the hotels again. That feedback loop is vicious. Weak city conditions hurt hotels. Weak hotels reinforce the story that the city is weak. Then the story itself hurts future demand. That is how empires unravel without a single explosion. This part matters a lot. San Francisco's hotel distress did not happen in a vacuum. It happened in a media environment where the city itself had become a political symbol. Crime videos, vacant storefronts, office towers, in trouble. Debates over remote work, fights about policing, public order, homelessness, and governance. Whether every headline was fair is almost beside the point. Perception becomes economics. If convention planners think attendees will complain, that matters. If companies cut travel, that matters. If downtown feels less alive after office hours, that matters. If nearby retail disappears, and the walk from one venue to another feels emptier, that matters. Hotels are downstream from all of it. A room night depends on 1,000 choices made by people who may never think of themselves as participating in commercial real estate, but they are. The traveler who skips the trip. The company that sends fewer employees. The conference that picks another city. The tourist who decides the vibe is off. Every one of those decisions shows up eventually in occupancy, rate, and valuation. San Francisco's image problems did not single-handedly destroy these hotels, but they absolutely helped strip away the confidence that once made their scale feel safe. Here is the cruel truth underneath this whole story. Massive hotels are amazing when the city is firing on all cylinders. They become brutal burdens when the city is not. A small hotel can survive on niche demand. It can get cute, it can discount quietly, it can reinvent itself around a smaller audience. A giant hotel complex is different. It has payroll gravity, operating cost gravity, debt gravity. It needs conventions, group business, steady flow, and urban momentum. It needs the city to keep proving its own relevance every day. That was the vulnerability here. Hilton, Union Square, and Park 55 were built for scale. But scale is unforgiving once demand softens. Suddenly, the same size that used to look powerful starts looking like exposure. Too many rooms to fill. Too much debt to justify. Too much physical presence to hide. Too much public meaning attached to every bad quarter. That is why the collapse felt so fast. Not because the weaknesses appeared overnight, but because once the market stopped believing in a quick rebound, giant hotels had nowhere to hide. Part of the shock here is that investors were not betting on permanent collapse. They were betting on recovery. That is the whole point. A city like San Francisco does not need to become perfect again for big hotels to work. It just needs to recover enough, fast enough, for owners and lenders to keep believing the old income machine will eventually come back online. That is what makes this story so brutal. The rebound never arrived with the strength or speed the capital stack needed. Room demand improved from the darkest pandemic period, sure, but improved is not the same thing as healed. Group business stayed weaker than hoped. International travel patterns were uneven. Tech sector travel habits changed. Office towers did not refill the way old underwriting models would have assumed. Downtown retail weakness made the surrounding environment feel less automatic, less premium, less dense, with reasons to linger. And giant urban hotels are not graded on effort. They are graded on throughput. How many rooms sold? At what rate? How much banquet demand? How much convention spill? How much food and beverage volume? How much confidence in next year being better? That last part matters a lot. Commercial real estate can survive bad current numbers if everybody believes the future fixes them. But once the future stops looking persuasive, current weakness becomes a knife. Suddenly, every month of underperformance is not a bridge to recovery. It is evidence that the old world may not be coming back in the old shape. That is what happened in San Francisco. The industry kept waiting for the normal urban playbook to restart, and downtown kept offering partial recovery at best. Not enough pain to create a clean reset quickly. Not enough strength to restore the old valuations. Just a long, ugly middle where hope kept getting smaller. And long, ugly middles kill leveraged hotel empires. The Hilton Union Square and Park 55 story also spread far beyond San Francisco because it was legible to everybody in commercial real estate. This was not just about one city. It became a warning about what happens when late 2010s pricing meets mid-2020s reality. Buy high in a premium urban market. Assume conventions come back. Assume business travel normalizes. Assume downtown prestige remains a durable moat. Then watch remote work, slower travel recovery, public order concerns, and harsher financing conditions all punch holes in that thesis at the same time. That is why these two hotels became such a famous distress case. They condensed a whole era of market confusion into one easy image. Giant four-star San Francisco hotels, once treated like fortress assets, suddenly being talked about like problem loans. And once that image settles in, it changes behavior. Lenders become colder. Buyers get predatory. Owners in similar markets start reviewing their own portfolios with new fear. City officials lose the luxury of pretending this is just a PR issue. Everyone understands that if assets this large can crack this badly, the old confidence regime is over. That is the real collapse inside the headline, not just property value, belief value. After the payment stoppage came receivership, lawsuits, debt sales, downgraded expectations, and a long, ugly public process of figuring out what these assets were actually worth in the new San Francisco reality. And that is maybe the most humiliating part. The old story said these were crown jewel assets in one of America's most famous cities. The new story said they were distressed properties whose value had cratered so far that opportunistic investors could start circling for the reset. That is a stunning downgrade in social meaning. Not just economic meaning, social meaning. Because cities use big hotels as civic self-portraits. They tell visitors, look how much business we do, how many conventions we host, how much demand we command. When those hotels crash, the portrait changes. Now they say, look how much is drained away. So, what is the actual warning here? It is not simply that San Francisco had a rough stretch. Every city has rough stretches. The warning is that hospitality empires built on perpetual premium city assumptions can unravel much faster than owners expect once demand, public perception, and debt costs all stop cooperating at the same time. That is the killer combination. Weak fundamentals, narrative decay, debt pressure. Suddenly, yesterday's fortress becomes today's surrender. That is what happened here. A pair of massive San Francisco hotels once carried a combined valuation of about $1.56 billion, then saw more than $1 billion in value evaporate as the downtown recovery failed to arrive with the speed and strength investors had counted on. And once one major owner decided it was smarter to walk than keep pretending, the whole market got the message. This was not a temporary bruise. This was repricing. San Francisco's Hilton Union Square and Park 55 were once valued together at about $1.56 billion, representing a huge, confidence-heavy bet on downtown San Francisco's business travel and convention machine. But pandemic aftershocks, weak office recovery, slow convention demand, city image problems, and harsh debt realities crushed performance. In 2023, Park Hotels and Resorts stopped making payments on the $725 million loan tied to the properties, effectively signaling surrender. By 2024, reports showed the two hotels had lost more than $1 billion in value, falling to roughly $553.8 million. That is the whole story in one line. San Francisco's hotel empire did not collapse because the buildings failed. It collapsed because the city and debt story holding them up failed first.